All right, so you want to kind of crack the stock market code in 2024. Well, you came to the right place. You provided us with the Stock Traders Almanac 2024, and let me tell you, this thing is jam-packed with potential insights. So we're going to dive in and break down some of the most valuable patterns and strategies. It'll be like having your own little cheat sheet for navigating the market this year.
Yeah, think of it like we're distilling, what is it, years and years of market data, all this kind of wisdom into these bite-sized pieces that you can actually use.
Exactly, exactly. And one of the things that really jumped out, at least to me, when we were looking at the almanac, is this thing called the 4-year presidential election cycle. You've heard about
Oh,
this.
yeah, absolutely.
It suggests that there's a real sweet spot for investors within this cycle. And guess what?
And we happen to be in it right now in that cycle.
We are in it.
Yeah.
Okay, so break it down for us. What exactly are we talking about here?
So if you look back historically, and we're talking since 1949, the sweet spot, as you called it typically runs from about the fourth quarter of the midterm year to, let's say, the second quarter of the pre-election year.
Okay.
And during that time period, we've seen some pretty significant market gains. The Dow Jones, for example, has averaged a gain of 19.3% during this sweet spot.
Hold on. The Dow Jones is up 19.3% on average.
On average, yeah.
During this period. Okay, so we're not just talking about like a small blip. This is significant. All right. What about, I mean, Dow's one thing, but what about the other indexes?
Well, across the board, you tend to see similar strength. The S&P 500, for example, that's averaged a 20% gain during that same time frame. And the NASDAQ, even better, 29.3%. So yeah, it's definitely something to pay attention to.
Wow. All right. So I'm officially intrigued. But what's the driving force behind these gains? I mean, why is this particular period, historically speaking, so strong for the market?
Well, in the market, there's always a lot of speculation, right? But one of the most common theories is this idea that incumbent presidents, they like to prime the pump, as they say.
Prime the pump. Okay.
Right. So basically, in the lead up to an election, they want to create this, this rosy economic picture, right? Hopefully boost their chances of getting reelected.
Makes sense.
And so that translates into policies, spending, things like that, that can often, at least in the short term, really kind of juice the market.
So it's like a well-timed, stimulus package almost for the market, right?
Politically.
That makes a lot of sense. All right, so we've got this 4-year presidential election cycle potentially driving some big gains, at least historically.
Yeah.
Let's talk about another pattern that really caught my eye. The January Barometer. I mean, this one sounds fascinating.
The January Barometer.
Almost like deceptively simple.
It is. It is.
But the Almanac claims it can predict how the market's going to do for the entire year just by looking at what happens in January.
Yeah.
Is that really a thing?
It has a surprisingly strong track record, actually. Since 1950, it's been right about 83.6% of the time.
Wow, okay.
Which is, I mean, for the market, that's saying something.
Yeah.
Basically, it boils down to this. If the S&P 500 ends January on a positive note, it's up for the month, the rest of the year tends to follow suit, generally speaking. And if January is down, well, historically, it has signaled we might be in for a little bit of a bumpier ride.
So basically what you're telling me is, come January, I need to be glued to my screen watching the S&P 500 like a hawk.
Pretty much. Yeah, it's definitely something to keep an eye on. Now, again, like anything else, it's not foolproof.
Right.
We've had those black swan events, those major global crises, or you just have these unforeseen market shocks. Those can definitely throw a wrench in the works.
Right, like we had back in 2020 when everything kind of went a bit haywire.
Exactly, exactly. But, by and large, those are usually exceptions.
Right, exceptions to the rule.
Right. So for someone like you listening, it's really about keeping a close eye on how January 2024 shapes up. It could be very telling about the year ahead.
Okay, got it. I'm putting that on my calendar right now. January 2024, watch the S&P 500. All right, let's talk about this other thing, this January trifecta. I mean, this sounds powerful.
Yeah, the January trifecta. What is this all about?
So the January trifecta, it's kind of like a combination of indicators.
Okay.
And it takes into account this January barometer that we were talking about.
All right.
But it combines that with a couple other things. It looks at the Claus Rally. So that's like the market's performance during the last 5 trading days of December, first 2 of January.
Okay.
And then also the first 5 days, just as it sounds. It's looking at the first 5 trading days of January.
So it's like this triple threat of bullish signals.
Kinda, yeah. If all 3 of those things line up, does that basically guarantee me a winning year in the market?
Well, I'd never want to say guarantee when it comes to the market.
Right, of course.
But, historically, it's a very strong indicator.
Okay.
When all three of those indicators have been up, the S&P 500 has ended the year higher, a whopping 90.3% of the time.
Wow.
And the average gain for those years is 17.5%.
A 17.5%.
Yeah.
That's incredible.
It's definitely something to take note of.
Okay.
And here's the other thing. The January trifecta, it tends to be even more accurate following a bear market.
Wait a minute. Didn't we just come out of a bear market?
Well, we might have.
I'm starting to see where you're going with this.
Yeah, it's interesting because the January trifecta actually occurred this year in 2023. So that's why, we're not saying predict the future or anything.
Right.
But history does suggest this could be a very positive sign, looking ahead.
Very interesting. Very interesting. All right, so I'm definitely going to be keeping my eye on that. That's, definitely something I want to watch.
Mm-hmm.
Okay, so we've talked about January, a lot about January.
Right.
But the almanac isn't all about January, right?
Yeah.
There's a lot more to kind of dig into here. Like, for example, I was really surprised to learn that April, not January, is historically the best month for the Dow Jones.
Yeah.
Why is that?
Yeah, it seems counterintuitive, right?
It does.
You think January, but April is when we tend to see a lot of companies releasing their first quarter earnings reports.
Okay.
And oftentimes those are pretty strong. And you get this kind of wave of optimism that can push the market higher.
Okay.
Plus, April also kind of marks the end of what the Almanac calls the best 6 month. It's this period kind of runs from November to April when the market, generally speaking, tends to do well because of a bunch of different factors.
Best 6 months. I like the sound of that.
Yeah.
But I have to admit, part of me is also a little nervous, right? We've got the election looming later in the year.
Right.
Could that potentially put a damper on April's, historical strength?
That's the million-dollar question. I don't know if we can say for sure, but it's definitely something to think about. Election years, they do tend to bring a little bit more, let's just say, volatility, a little bit more uncertainty.
Sure.
Which sometimes, can impact how the market performs.
Right. Okay, so it's not all, sunshine and rainbows. Even though we have these historically strong periods, the market does have its corrections too.
Of course, yeah.
The Almanac does talk about those as well.
Yeah, absolutely, yeah. And I think it's important to remember, the market, it moves in cycles, right?
Right.
We've got our upswings, we've got our downswings, and as much as we might want to just focus on the upswings, it's important to, understand the downswings too.
Absolutely. So where do those tend to happen? Are there any particular months where we should be like, ooh, maybe tread a little carefully here?
Yeah, September, historically, that's been a bit of a softer month for the market. Yeah, and, some of it, I think, is psychological. People come back from summer vacations. They're getting ready for, the end of the year, maybe feeling a little more risk averse.
Yeah, I can see that.
But I think more concretely, September tends to be when you have a lot of investors engaging in what's called tax loss selling. Basically, if they've got any stocks that have lost value throughout the year,
right,
this is a chance to sell them off, offset any capital gains they might have, reduce their tax burden.
Okay.
But that, of course, that selling can sometimes lead to a little bit of a temporary dip in the market.
So if I'm not worried about offsetting gains, you're telling me September might be a good buying opportunity.
It's possible. Now, here's the other interesting thing, right? So we talk about September, and people get a little, maybe a little jittery, but then you've got October, and everyone's heard of Octoberphobia.
Right.
We've had some historical crashes in October.
Yeah.
But interestingly enough, October is often when bear markets end. It's almost like the market needs to get that, get that fear out of its system.
Right, get the scare out.
Exactly, before it can kind of bounce back.
So almost like a little bit of a silver lining to that September slump.
Yeah.
Maybe presents a buying opportunity for those who aren't as worried about those short-term gains.
Yeah.
Really interesting stuff.
Exactly. And, I think it highlights the importance of, not just reacting to the market, but trying to understand these seasonal patterns, use them to your advantage, whether you're, trying to find a good entry point or you're just kind of bracing yourself for a potential dip. It's all about being informed.
Absolutely. Okay, so we've talked about these yearly cycles, the monthly trends, but this almanac also goes even deeper.
Oh, yeah.
It talks about something called sector seasonality. Have you heard about this?
Oh, absolutely.
Break it down. What's the deal with sector seasonality?
So sector seasonality, it's this fascinating idea that, different sectors of the market, they tend to kind of have their own little mini cycles throughout the year.
Okay.
Some do better at certain times than others.
Yeah.
And the Almanac actually has this really cool table. It's called the Sector Index Seasonality Table. And it kind of maps out all these historical trends. For example, tech stocks, they've traditionally done really well kind of that April to July period, whereas, financials, they often outperform kind of that October to May period.
So it's not just about, when to be invested in the market, but also where to be invested.
Exactly. Exactly. It adds a whole other layer of strategy, to your decision making.
Absolutely. Absolutely. This is like next level stuff here.
It is.
What about like gold and silver? A lot of people are always curious about precious metals, especially during times of maybe economic uncertainty.
Right, right. And, gold and silver, historically, those have tended to shine, if you'll pardon the pun, kind of that July to December period.
Okay. So, yeah, I mean, if you're looking at precious metals, that might be a time to, pay a little extra attention.
This is really valuable information.
Yeah.
Just to think, like, if you could kind of anticipate some of these sector trends and, position yourself accordingly throughout the year, it'd almost be like having, I don't know, like a little secret roadmap to market success.
Right. It's like having a little bit of an edge.
Exactly, exactly.
And, again, it's all about understanding these historical rhythms of the market and then using those to potentially, enhance your returns.
Right, right. Okay, so we've covered a ton of ground today.
We have. I mean, we talked about presidential election cycles. We've talked about all these January indicators. We even got into seasonal surprises, sector seasonality. I feel like we've only just scratched the surface, though, of what's in this Stock Trader's Almanac. Are there any other kind of hidden gems in there you could tease for us before we wrap things up?
Honestly, we could probably do a whole nother deep dive just on some of the other things that are in here.
Right.
But just to give you a little taste, a couple other things to look for. There's something called the down Friday, down Monday pattern.
Right.
It's this kind of interesting weekly trend in the market.
Interesting.
There's the December low indicator, which, it's not always perfect, but it has historically been a bit of an early warning sign for potential kind of market hiccups down the road. And then, if you're looking for a little quick win, maybe before the holidays, there's something in there called Wall Street's free lunch.
Wall Street's free lunch. All right. Now you're talking my language. That one I got to hear more about. That one almost sounds too good to be true.
Well, I don't want to give away all the secrets.
Okay.
And I think that's the beauty of the Almanac, right?
Yeah.
It's just jam-packed with these little intriguing tidbits that, they really make you want to dig in, uncover all that wisdom that's in there. And, hopefully we've at least given you a good taste.
A great taste.
Given you a good place to start. And now you can kind of take it from here and do a little exploring of your own.
Absolutely. So if you had to leave our listeners with just one kind of key takeaway, big picture from your perspective, what would it be?
I think the big thing to remember, and I know we've kind of touched on this throughout our conversation, but as amazing and as insightful as this almanac is, it's packed with data. It's packed with patterns. It's not about predicting the future.
Right.
The market is constantly changing, evolving, and, there's always a million different factors at play. So you can't take anything as a guarantee. Use it as a guide, use it as a roadmap, but always, always be ready to adapt.
Right. The market's going to do what the market's going to do.
Exactly.
But if you're informed, you're in a much better position.
Exactly. Exactly. I always say, the most successful investors out there, it's the ones who can combine that historical knowledge, but also that awareness of what's happening in the market right now, and then just a healthy dose of critical thinking.
Absolutely. It's not just about following the patterns. It's about understanding the why behind them.
Exactly.
Fantastic. Well, you have given our listeners so much to think about today.
Well, I hope so.
And probably a whole bunch of reasons to maybe go out and grab a copy of this almanac for themselves. So as always, thanks for joining us on this incredible journey. It's been a fun one. Until next time, happy investing, everyone.